All right, let's kickstart the first conversation of the day. And like I said, that has to do with balanced advantage funds. Let me introduce my guest. We've got Santosh Navlani, who's the Chief Operating Officer at ET Money. Thank you so much, Santosh, for taking the time as always. And, before we get to balanced advantage funds, let's talk about the context a little bit because you've seen quite a bit of volatility in the equity markets. Some investors that have come into the fray over the last couple of years have not witnessed this kind of volatility, right? Um, an asset allocation strategy would serve people well in this situation because you buy and sell when the markets move in certain directions. Can you first explain what that looks like, and then we'll get into balanced advantage funds?
Sure. Hey, Alex. Hi. Typically, what we've been all used to as investors is pick up an equity fund for long-term goals, start an SIP in them, and keep buying at every level. As time would have it, typically market volatility catches up with a bull market that, as we saw in 2021 and early part of 22. What happens is market starts correcting, and you suddenly realize that your portfolio is starting to look red, especially if you have started recently. And if you've not started recently, you started in the past as well. You probably some of your gains would have evaporated by now. Now, typically, most advisors or portfolio managers would recommend that you should keep booking profits over a period of time as market progresses or market rises. And one of the ways to do that in a non-timing the market kind of manner, or not looking at levels to exit, having a target in mind, is a better approach of asset rebalancing. Where when I start investing, I know that I'm putting 80% of my savings into equity funds and 20% of my savings into debt funds or non-equity funds. And suddenly, when market has risen, my equity component starts looking like very high and maybe 88%, maybe 90%. I just regimentedly take a look at it, rebalance my portfolio in a way that I sell some part of my equity and invest that part in debt so that the asset mix starts to look around 80-20 again. So that's typical asset allocation way of investing. But unfortunately, what happens is most people don't know what their asset allocation should be. And that's where balance advantage comes in handy, where they actually can provide you good solution if you don't understand how to allocate assets of your savings into different asset classes.
Let's talk about that then, because I was going to ask you one more question, which is that people generally miss the bus, right? They don't allocate necessarily on time. They wait for certain corrections, they wait for a bottom, and then in retrospect, everything looks perfect. The other issue is that a lot of people don't necessarily have the time or the bandwidth to do this. And like you said, maybe they don't have the expertise to identify what the asset allocation strategy should be. So, what are balanced advantage funds and how do they work?
Alex, there is a saying in the marketplace that more money has been lost by waiting for corrections than actually in corrections themselves. Typically, what happens is we as investors have a lot of emotions when we put our money to work, and typically in the emotions we end up taking wrong calls. Sometimes there is a fear of missing out, and we actually invest at the high end of the market when market is actually given a lot of returns in a very front-loaded manner. Or sometimes what happens when market shows correction, we actually become very fearful and say that I don't know whether I should be investing right now. Let me hang around. Let me see if the market where the market bottoms out. And sometimes market bottoms out, but you don't know the bottom is there. And if the market makes a very sharp reversal, as we saw in March 2020 as well. And even right now, when we've been witnessing the market volatility in last few months, when the market has actually gone to like 15,600 levels, it has bounced back very strongly from those levels, like almost 2 or 3 times right now already. So what happens? You wait for the bottom, but you don't know the bottom is there or not, and that's where balance advantage funds come in, because they don't have the emotional approach of investing where they take a call on timing of the market or they take a call on valuations. They just follow a simple principle that they probably write in their scheme information document that this is how the fund is going to invest. So some funds actually follow PE-based model, like price to earnings ratio. So they will look at valuation from a PE lens and say the market is expensive. Let me not have all my money in equities and have a lot of money in debt. So over last 1 year or so, most of the balanced advantage funds actually have been maintaining very conservative equity allocation of almost 25 to 40% max. And that has come very handy for people who are invested in them, because they have not fallen much. In fact, they may have gained by actually using the debt allocation portion by investing into floating rate and or floating rate funds and things like that, and they may not even have fallen on that side. So what happens is you basically tend to kind of cut down your equity allocation to markets on extreme high level, and vice versa as well, where markets actually bottom out pretty fast, but you are fearful. If you are investing balance advantage funds, you don't need to worry about what the fund manager will do, because fund manager will actually buying when market correction is there. So most people may be aware that when March 2020 happened, a lot of balance advantage funds actually hiked their equity allocation from average of 50, 60 odd percentage allocation to almost 75, 80% percentage allocation. And most of these balance advantage funds actually give equity kind of returns simply because they were actually able to buy the bottom and they were not suffering from the loss that equity funds were suffering. So what happens is basically, as you said, we don't have bandwidth, we are busy in our lives, we're busy in our jobs, and we don't really understand markets as much, and we don't want to understand the markets as investors at times. So you basically give that job to a fund manager, where the fund manager is not actually managing a large cap or a mid cap fund, where the mandate is always stay invested in large mid cap funds. You are somebody who has goals in mind. You are basically or somebody who cannot fathom the downside of a market of 20, 30% at one go. That's where balance advantage funds come in. They actually fall less and they almost gain as much as equity gains. So if you look at long-term performance of these funds, sometimes you might be surprised they almost are equivalent Nifty 50 kind of index in that sense. And that's a pretty good deal to have in life, where you over a long period of time of 10, 15 years, you're almost earning index kind of returns, which most funds fail to deliver, or you as investor fail to achieve, simply because you act emotional, and a balance advantage fund will not act emotional. It will always invest the way it should be done.
Okay. So the first question, then, as a follow-up to that, is um, is it right to benchmark this to the index? Would you say that you can draw that comparison, considering that it's hybrid?
So I wouldn't say it is, you can draw a comparison to index. It is incidental that they end up giving you index kind of returns over very long periods of time, like a 7 to 10 year period, or maybe a percentage less than that. But what is important is they actually don't fall like index. So if you are as an investor who is actually very willing to stay invested for a very long term, like 7 to 10 to 15 year period, for your core life goals, retirement, children's education, and you are somebody who doesn't really want to time the market, who are not understanding how to really act about asset allocation of your investments, these funds tend to give to a job in a way, because they fall less in market falls, and markets typically fall more. So it's not the markets don't fall when they are undervalued. It's not like that. But markets tend to fall more when they are overvalued. Markets tend to fall more when they're fairly valued. But markets don't fall more beyond a point if they're already undervalued. So balance advantage funds, chances are very high that they will be actually over allocated to equity, or very high allocated to equity, when markets are either undervalued or less than fairly valued. So when typically these kind of situation comes, there is always a very strong rally which sometimes comes in marketplace. And if you are a balance advantage fund investor, you'll benefit from that rally. And the same goes vice versa, where typically when markets are overvalued or very highly valued, typically the allocation debt will be very high in these funds. So you tend to fall less. So because you fall less and you gain like equity over a long period of time, the returns look like index. It doesn't mean that you should be comparing and benchmarking these against the index funds. They are a very good option against a typical balanced fund, as we used to call them, and now they're called aggressive hybrid fund. So I would say for a lot of conservative to moderate investors, balanced advantage funds are healthy replacements for aggressive hybrid funds. But I would not say that go in these kind of funds against equity.
Santosh, we were talking about the key facets of balanced advantage funds, and you were pointing out that they're less volatile than equities. There is a measure to that, right? And you've done the data crunching. Could you tell us a little bit more about how they deviate from the equity asset class in terms of volatility?
So, as we talked through the show, Alex, because these funds have typically very less allocation equity in very valued, highly valued, overvalued markets, they tend to fall less. And because they also tend to have more equity allocation, markets are not really expected to fall more in undervalued scenario. They tend to fall less even if market goes further, and if the market starts rising, they benefit. So what happens is the range of returns that you can expect from balance advantage funds is actually quite tighter compared to the range of returns that you can expect from equity, because equity sometimes can double your money in a year or less than a year time, and sometimes it will not give you returns for long periods of time. So what happens is the range of returns that you can expect in a worst case scenario from equity, or in a very good case scenario from equity, can be very, very different. Sometimes you can make 100% in a year. Sometimes you might not be able to, sometimes you might actually make 30-40% drawdown in a year. So the range becomes so high, and hence there is a measurement of risk, which is standard deviation of returns that you can call. It's typically very, very large for Nifty or any kind of equity fund. So typically in the range of 18 to 22% for most of the market cap indices. I wouldn't know exact value over each of these index, but typically it's ranged from 18 to 22%. Where vis-a-vis when you look at a balance advantage kind of fund or a balance advantage category, you would typically see the range of returns or the standard deviation of returns will be in the range of 9 to 12% kind of number. And that is barely like half of the risk, as we can call it, compared to the full equity fund. So you are basically getting in the long run returns which are not very far from an equity fund or an index fund, large cap index fund. And in the you're not actually having a risk which is as high as 18 to 22% standard deviation. You're getting only about 8 to 12 or 9 to 12% kind of range. You typically are, as an investor, can expect to have very tighter range of returns and not having negative surprises in your portfolio. And you may get positively surprised by actually giving very healthy return over a long period of time. So typically we call these funds as low risk, medium return funds, if I can use that word, compared to a low risk, high return, which doesn't exist in life, or a high risk, high return kind of equity funds. So these are basically, low risk, medium risk, and medium return, high return kind of funds over a long period of time is what you can expect from these funds.
As I understand it, the returns that you get, speaking of the returns, the tax treatment is of an equity fund. But as you've mentioned, as things stand right now, you have a lot of funds that are maintaining about 40% of equity. How is it they're still giving you equity treatment with regard to taxation then?
So most of the funds, Alex, in this category actually typically range from 30 to 80 as net equity allocation. But for tax treatment, what happens is the non-equity portion of the fund manager typically invest in arbitrage opportunities. So as per Indian taxation rules, if a fund has been maintaining on an average 65% allocation towards equity or equity kind of instruments over the entire financial year, then it qualifies for equity taxation treatment, which is 15% of tax on short-term gains that you'll make and 10% long-term. So what happens is to qualify for 65% threshold, whenever the fund is having 65% or lesser allocation, they would try to make up by putting in arbitrage opportunities, which actually qualifies as equity instrument. And so you as an investor can get the feeling of taxation, which is like equity funds. And in very rare cases, some of the funds actually don't take arbitrage opportunities and they put money in debt funds. And in which case that fund would typically be kind of, subjected to a debt kind of taxation because equity portion can fall less than 65%. So whenever that happens, you will be basically subject to debt taxation. I would believe that if you are an investor who are actually very long-term oriented investor, you should not be worried about whether the balance advantage fund has an equity taxation or a debt taxation. These funds are not suitable for less than 1 year anyways. You are actually investing in them typically when you have 3 to 5 years minimum horizon under your disposal. And in that case, both equity and debt taxation will not really pinch you beyond the point on returns if you are a long-term investor.
We've displayed on the screen some of the data that has been shared, and we've talked about rolling returns as well. We've compared them to index, and we've also established you can't do a like-to-like comparison with equity. But having said that, there are so many funds now in this category. It's a growing category. It's already a large category. How should the investor choose the right fund for them? Because they're not all the same in terms of strategy, right, Santosh?
Yeah, so they are not same, Alex. Some of the funds actually are, as they call them, just pro-cyclical. Some of the funds are counter-cyclical. To put in layman's perspective, there are funds who actually do the job as balance advantage funds are supposed to do. They basically it basically means these funds buy more of equity when markets are undervalued. They buy less of equity when markets are overvalued, and whenever the markets they are less in equity, they put the remaining portion in debt. So these are the funds which are basically counter cyclical approach. So they always trying to manage risk in the portfolio. They try to control risk, control downside, and give you healthy returns over a long period of time. So an ICICI Balance Advantage Fund, the largest fund in the category, actually follows this approach. Even funds like Motilal Oswal Dynamic Equity Fund, or for that matter, IDFC Balance Advantage option, even I think Kotak Mahindra's option, they typically follow all these, counter-cyclical approach where they actually buy more of equity only when there's undervalued markets. And on the other hand, there are funds which actually use a mix of both approaches, like a valuation as well as trend-based thing, where trend means that you are running with the trend and not taking a very counter-cyclical approach, like you're doing pro-cyclical approach. So Edelweiss Balance Advantage Fund is actually quite healthy fund there. What it does is it actually looks at valuations, but also looks at trends in the market. So if the short-term trend, long-term trend of prices is basically positive, so they would not cut down equity allocation, which means that if the market is rising or expected to rise, they would put more money into equity and they will not cut down equity allocation even if market continues to rise up. So in what happens in this kind of scenario, an Edelweiss Balance Advantage Fund will probably may fall more at times because when market takes a sudden reaction, vis-a-vis an ISIS Balance Advantage Fund will not fall more if the market takes a sudden reaction because it will not be invested in equity. So both these are exactly opposite, I would say. So if you're an investor who's willing to, who's looking to really invest for super long term, both these funds actually can complement each other in your portfolio. Otherwise, most funds actually follow a very counter-cyclical approach like ISIS Balance Advantage Fund. Most of these funds also look at multiple parameters like interest rates in the economy, domestic flows in the equity markets. Sometimes they also look at inflation. Some of these funds also look at other complex parameters on the profitability side as well. So it all sometimes fund also look at dividend yield of the index in that sense. So they all funds have different parameters, but I think there are largely two: counter-cyclical and pro-cyclical, which respectively are ICSE and Edelweiss.
Thank you so much, Santosh, for spelling that out. Pleasure speaking with you. And I'm sure my viewers know a lot more now about balanced advantage funds.
Thanks, Alex.